about what does it practically mean? Well, today we're going to take an hour out of our schedules to find out. This is the fourth session in our 2026 Underwriting Essentials series. Now, the series tackles underwriting fundamentals that are relevant to practitioners across all classes of business. And we're very pleased that today's session is also forming part of London Risk Week. So, a very busy week of sessions, and we are one of the sessions across that week. My name's Tom Hughes, and I'm the Director of Underwriting at the IUA. Now, in case you haven't come across the IUA before, we are the trade association for the company market. There's about 80 insurers and reinsurers within our membership. Now, I'll move to the next slide and take the opportunity to highlight a number of upcoming IUA events. Now, we will send details of these events to those of you on our mailing list. You can also find them on our website or via regular updates on LinkedIn. And there have already been a few sessions, not least some provided by today's speaker, Andrew, as part of this series. And you can find those on the IUA's YouTube channel. And before we get to the main event today and pass over to Andrew, I'm going to give you a little bit of context about aggregation in insurance. Now, IUA runs committees across almost all classes of business, and we bring together practitioners to discuss common issues and to promote good practice. And this means we have a very good view of the most significant risks that are facing our member insurers and reinsurers. And I'll briefly give you a top three to consider as we move through today's presentation. So if we go to the next slide, the first risk we're going to talk about AI and automation. McKinsey's survey had 88% of respondents say their organizations use AI in at least one business function in 2026. That's up from 55% in 2023, pretty significant growth. Now, when it comes to our members, we've got PI insurers who are exploring law firms' use of AI tools, cyber underwriters considering AI-enabled attacks, D&O practitioners focused on governance risk. Now, these insurers are, of course, thinking about the unique risks posed by AI. Some of those are deepfakes, hallucinations, the misuse of AI for disinformation and societal instability. And then, of course, IP infringement, algorithmic or model bias. Now, given the breadth of use of AI at the moment, the aggregation risk across multiple insureds relying on a single AI tool is very real. And that aggregation could also flow from litigation or regulatory actions. So there's one risk to bear in mind as we move through the aggregation presentation today. Now, on the next slide, we'll talk about evolving natural catastrophe risk. Of course, changes in the climate are resulting in changes in catastrophe events, both from a frequency and from a severity perspective. Now, events once considered 1 in 100 year occurrences are happening more than once a decade, and they're also arising in locations that we are less used to seeing them in. Think about the extreme floods in northern Italy in 2023 and 24, in UAE in 2024, and in Spain in the same year. And then wildfires burned over 2.7 million acres across the European Union in 2025. That was a worst year on record for Europe. Now, whether it's flood, wind, wildfires, heat stress, subsidence, and secondary perils, they are all increasingly interlinked and sometimes arising from the same climate conditions or event. And a really good example is intense heat and wildfires, and following those, floods and landslide risk directly correlated and increasing. Now, what these events show, and I know we're having a whistle-stop tour at the moment, is that Nat Cat risk is not only intensifying, but it's getting less predictable geographically. Aggregation increasingly comes from unexpected places rather than where models have historically told the insurance industry to look. Now, finally, that was number two. We'll go to number one, geopolitical instability and war. How could we not talk about it at the moment? There are, of course, robust policy structures in place in the market with specific dedicated war policies addressing many of the exposures that will be front of mind when it comes to traditional war risk. But broader geopolitical risk, be that from cyber operations, from supply chain disruption, sanctions, and state interference, they all blur the lines between war, crime, political, and terrorism risks. Now, they can create cross-border aggregation, and it's often triggered indirectly and outside of traditional war scenarios. As well as crossing borders, the same geopolitical triggers can impact a range of policies provided within the London market simultaneously, be that property, marine, aviation, political risk, trade credit, cyber, or liability. So there's just a flavour of some of the biggest issues that are on our members' agenda around aggregation at the moment. Across these areas, the common thread is that risks are increasingly becoming connected and aggregation more systemic. So the challenge for our members and for the London market is not necessarily a lack of awareness of these risks, but ensuring that the management around aggregation is going to evolve as quickly as the risks themselves. Now, with all of that being said, there is no better time to hear from Andrew on aggregation as part of this fundamental series. So we'll flip to the next slide and I'll let you know that hopefully we'll have a minute or so for questions at the end of the session. There is a Q&A function within the platform and we will send the slides and a recording of the session around after the event. We've been really looking forward to this one, so I'm very pleased to pass over to our expert, Andrew Schutte, partner, head of reinsurance at Keoghs. Andrew, we're in your hands and look forward to hearing from you today.
Thanks, Tom. Morning, everyone. That was a mood lifter, wasn't it? Fires, AI, war. Yeah, that's what's keeping us busy right now. So, yeah, good morning, everyone. We're going to spend a happy hour looking at aggregation. If I look over here, it's good my screen's there, but I'm very much focused on you guys. That's me, as Tom said, head of reinsurance at Keoghs, and you can think of me on coverage, think of me on wordings. It's really my bag. And what are we going to talk about today? Well, let me show you. We're going to remind ourselves what aggregation is, and we're going to remind ourselves why it's so important. We've already had a little flavor of that from Tom. We're going to look at narrow and wide words. This is quite a language heavy session, I must say. So narrow and wide words. Then we're going to look at some of the particular words that we come across in different lines of business and how aggregation might work for those different words. So you're going to be treated to event, occurrence, claim, premises, catastrophe, and more. So hopefully whatever your wording's got will have something to say for you. And then we'll look at some hours clauses, we'll look at sole judge clauses, and then you'll be done. So, like I say, a lot of language in this session, because when it comes to aggregation, how it works, we know from years of experience and lots of court cases that it's all about the words that get used. You know all of those? Quite like a quarrel of lawyers, sentence of judges. Yeah. Anyway, collecting things together is really what this is all about. So, as Lord Justice Rick said back in Scotland, Copenhagen Re, what are they there for, these clauses? Well, they're going to police the imposition of a limit by treating lots of losses as if they were one thing. That's basically it. This chap was from Australia, but we won't hold it against him. He said, usefully, Emmett said, what we're doing here is to get two or more separate losses covered by a policy to be treated as a single loss for certain purposes, as long as they're linked by a unifying factor of some kind. And then he said, in order to determine at what level the unifying factor is to be determined, we've got to look at the words. Look at the words. So we're literally talking about a grouping. An aggregation is just a grouping. It could be a grouping of losses, or it could also be a grouping of deductibles or excesses or self-insured retentions, which are largely, by and large, the same thing. So limits and deductibles. So we're looking at groups of things. Those of you who are at any of my previous sessions will know that one of the things that is vexing me at the moment is massive groupings of selfies that my daughter takes on my phone. So they've got a group of all of those. It's actually dropped off a bit. Since we last spoke, it has dropped off a bit. So I'm glad to report that putting the phone away has been working okay. But I have thousands of people of these images spamming up my phone. An aggregation of, I don't even know what you call it, selfies with filters, I guess. Anyway, so why is aggregation important? Why? Well, it's really about money. I can show you how this works most easily using some pictures. So let's go for it. So imagine that we've got a very simple placement. Primary layer is 1 million each and every claim. Excess layer is 4 excess 1 each and every claim. And then, well, actually above that, there isn't any more insurance. It's all self-insured. So that's the structure. Let's put a loss through it and see what happens. So if we have one loss of 10 million, the way this works is the layer 1 insurers, they pay 1 million. The layer 2 insurers, they pay 4 million. And the policyholder is carrying 5 million. That's for one loss, one claim, because we're each and every claim. Now, change the facts slightly and say that we've got 2 claims. The amount that we're talking about here in terms of loss is the same. It's still 10 million, but it's been divided up differently. The layer 2 insurers have got double the pain. They're on 2 million. The layer 1 insurers double the pain, 2 million. Layer 2 insurers double the pain, 8 million. And the policyholder's feeling quite smug because they're paying nothing whatsoever. Change it again and give us 10 claims, each of 1 million. And it's happy days for the policyholder. It's also happy days for the layer 2 insurers. But layer 1 insurers are really feeling it. They're paying the whole 10 million. And that really, in a nutshell, is why aggregation is important. How claims are aggregated or not can have a significant dollar outcome. And who it's going to benefit to aggregate in one way or another is hard to call. As Lord Justice Toulson sagely said in AIG and Woodman, aggregation clauses can operate in favour of the insurer, but sometimes they operate in favour of the insured. So we don't approach them with a predisposition to a broad or a narrow interpretation. We just come to it with a sort of neutral view, because sauce for the goose can be sauce for the gander. And I have had it in the past where I've been asked by a client to see if there's an argument to be made to aggregate in a particular way, and we make the argument, and then more losses come in. The client runs the numbers and thinks, oh, well, actually, it would be better if it worked in a different way. And then they say, can we argue it a different way? And I said, well, that could be tricky. Maybe. It could be tricky, but inconsistent. So it's hard to call who this is going to favour before the facts emerge. That said, we also have some guidance from the English court about the value of precedent in this area. So this is Lord Justice Andrews saying in Spire Healthcare that we'll come back to later. We've got a standard wording here, so we should try to follow the construction of similar provisions in earlier cases, unless we really don't have to try to give predictability. So if we have a clause that we're trying to understand, an aggregation clause that we're trying to apply, where we can, we should follow precedent. So that's all sort of by way of introduction. Now, I've said that language is super important in this area, and so it is. So we're going to be looking at lots of different unifying factors, to use the words that we were looking at a moment ago, lots of different ways in which you can aggregate. And one thing that I'm sometimes asked is, well, what is wide and what is narrow? And the truth is, it can really depend. So not in a sort of legalistic or formal way, but just in an informal guidance type spirit. I've put a little bar across the screen here, narrow on the left, wide on the right. And here I've plotted some language going from the narrower end of the spectrum to the wider end of the spectrum. Now, this cannot be a sure guide because all of these things could be defined in your policy, and that could change the goalposts entirely. And the words that you use the surrounding words that you use, contextual words that you use, could also change things. But basically, if you're looking at something on a per claimant, so that claim could be a third party against the insured if it's third party business, or it could be a claim by the insured for indemnity for first party or third party. That's likely to be reasonably narrow. In other words, you're going to have lots of little things in that scenario. More likely to have lots of little things than one big thing. Moving across, events, occurrence, loss event, accidents, those you could have those be, those are a little bit more wide, basically. So a loss event could give rise to more than one claim, for example. Then moving across, cause or source or originating cause, that is wider again. And then towards the right-hand side of the screen, you've got a series of things, a calamity, a catastrophe, disaster. Those tend to be towards the wide end of the spectrum. So depending on what type of word you are using here, what unit of aggregation you are using, the net is likely to be drawn narrower or wider. And this is just a little guide for you. We're going to talk about, I think, most of these in more detail in a minute. But there you have a suggested sliding scale. All right, so now let's dive into actual language. And I hope you're ready for a bit of case law. There's a lot of case law in this session. So if you don't like case law, I'm sorry about that. But that really is what we're going to be spending at least half an hour on, probably. So the first case that I'm going to talk about comes out of Operation Desert Storm. If you're a certain age, you might remember that. Gulf War #1, basically, in the 90s, early 90s. And this is Kuwait Airport in a state of some disrepair. Yeah. So the case was a 1996 case, and the facts were these. So the Iraqi forces attacked Kuwait Airport, and they requisitioned 15 aircraft, which they flew out over the following days. The Kuwait International Airport made a claim for $692 million under its war risks cover. And the reason that this was important from an aggregation perspective was the policy limit was not going to be enough if we only had one occurrence in one location, because there was only $300 million, any one occurrence, any one location available. So the obvious question, have we got 15 occurrences here, or do we have just the one? And the swing on that answer to that question, as you can see, is $392 million. So it's probably worth going to court over. So Mr. Justice Ricks, as he then was, looked at this, and he adopted a thing we call the unities test from an arbitration decision called Dawson's Field. Have we got unities of timing, location, cause, and intent? He asked. And what he found was the aircraft were all lost on the 2nd of August, so we got unity of time. We got unity of location. It was all at the same airport. We got unity of cause because the Iraqis intended to capture the aircraft and treat them as acquired from the moment the airport was captured. So the occurrence was the successful invasion of Kuwait, incorporating the capture of the airport, and with it, the aircraft on the ground. So you got 300 million, and that's it. And that unities test is something that we need to come back to and explore further. There was quite a lot of litigation that came out of all of this. So Desert Storm, I think, was 1990, 91. Scott and Copenhagen Re is a follow-up case to the Kuwait Airways case. And as you can see, is over a decade after the events in question. Here, it was a claim for a jumbo jet, which was also at the airport when the Iraqis captured it. But it sat there and wasn't moved. So the Iraqis didn't fly this plane out. It remained at the airport. And then when Desert Storm came along, the Allies destroyed it inadvertently. So this matter went before Ricks again, but this time in the Court of Appeal. And he said, we don't have unity of time here with the loss of the 15 aircraft, because this all came about rather later on. The 747 was actually destroyed by Allied bombing. It wasn't destroyed by the Iraqis. So that gives you a feel for what we're looking at when it comes to occurrence. Now, I've grouped together event and occurrence for this part of the talk because, as we learned from Kuwait Airways and more recently the FCA test case, event and occurrence just mean the same thing unless your contract says different. And on the point of events and occurrence, what is the touchstone for all of this, if you're, as well as the unities test, it's Lord Justice Mustill's observation in AXA Re and Field in 1996. An event, an occurrence would be normally the same thing, is something which happens at a particular time, at a particular place, in a particular way. A cause is less constricted. That's why I put it a little bit further to the right on my little chart. So something that happens at a particular time, particular place, in a particular way. That's one touchstone, and the unities test is another. So time and location on the unities is normally reasonably straightforward. Cause is less so, and intent and motive is often, although it was referred to by Ricks back in Kuwait Airways, it's often not really gone into in very much detail and can be ditched altogether. Cause, intent, and motive are sometimes elided, so they're all treated as one thing. So time, location, pretty easy. Cause, intent, motive, harder, factually harder. And we need to be careful with the unities test. We need to be applying our brains really and being cautious. As Julian Flo said, as the Chancellor of the High Court in the Unipolsci case, we're also going to be talking about that in a minute. He quoted Jeremy Cook to say the unities are just an aid to determine whether the circumstances of the losses involve such degree of unity as to satisfy the contractual aggregation requirement. Coming back to the language, coming back to what it actually says in the policy. So a guide, but not an infallible guide, the unities test. So remember that, and remember what Mustill said about events and occurrences, particular time, particular place, in a particular way. Those are the touchstones, really. So we can see this all being played out in some detail in Skye and Riverstone, which has got some unusual language in it, but it's a bit more recent than the other cases we've been talking about. So it's a constructional risks claim, this one, by Skye against the insurers for water damage to a roof. And the roof was made up of 472 wooden cassettes, and they got wet. And they got wet because there wasn't a tin hat over the works. So the rain came and made these cassettes work. And the policy said retain liabilities. There's really one about the self-insured retention. Retain liability, 150 grand any one event. Well, if you've got that multiplied by 472, that's going to do away with the claim, more or less. But Mr. Justice Pelling found that that was not the way that it should work. There was only one event, and that event wasn't multiple bits of rainfall. It wasn't rainfall affecting 472 cassettes. No, it was the decision to omit using a tin hat. He said if at least an effective cause of the damage that occurred during the period of insurance was the decision not to put on a tin hat, temporary waterproofing measures, then that will satisfy the unities of time, place, and cause. So it was a decision in that case. Now, we're not always looking at something as intangible as a decision. Often we think of an event or an occurrence as being the fire, the flood, the earthquake, the act of negligence. And this extends that last category in a way. It's talking about something intangible. It's talking about a decision. So we now know for sure, because the Court of Appeal agreed with him, that a decision can be an event or occurrence. And the court went into massive detail of looking at how the language and the policy worked when you look at it as a whole, in trying to work out how the thing should be construed. So they found event referred to the cause of the damage, not to the damage itself within the context of this policy, because it was all a bit unusual. The policy had a per loss deductible for the default cover, which was 10 grand. So that was the starting point. If you're trying to look at how much these guys should be retaining, how much should this guy retain, well, it's normally per loss, £10,000. And then it was only for the defective design cover, where it would never be the fire or the flood or the earthquake that would be the trigger. It was always going to be defective design as a sort of underlying cause. For that, 150 grand retained liability. And then you had an hours clause, which we'll talk about in more detail in a minute, but it's basically padding out and explaining what happens when it comes to aggregation. That hours clause said 72 hours of storm would be deemed to be a single event and one occurrence was not enough. 72 hours of storm would be deemed to be a single event and one occurrence, but that was not enough to oust the conclusion that here any one event meant any one cause of damage, because what they were saying was this defective design cover is not going to, it doesn't really respond to the storm as such. What it's responding to is defective design as a cause of loss. So in other words, there was inconsistency within the wording, and this was how the court decided to square the circle. They said it's only one deductible, so you get to knock off 150 grand, but then insurers have to pay the rest. And the Court of Appeal said if a particular decision fulfills the unities, well, that's going to be a factual evaluative assessment in each case, but definitely a decision can be an event or occurrence. So once again, language, totally key. Also, the other feature of all of this is that the facts get a very, very thorough going over. So you might be seeing already why it's the case that coverage lawyers like myself make quite a lot of their income from dealing with aggregation. There's quite a lot to go at. Now, before we leave per event or occurrence, we've seen in these cases some reference to cause, and I need to unpack that a bit for you, otherwise you don't really have the full picture. And here we're going to go back to another reasonably old case, Caudle and Sharp. And this is one of, there's more than one of these, but this is a case where the event in question is some allegedly negligent underwriting. So it's all quite close to home. Anyway, what you can see on the screen is a classic reinsurance clause. Loads of words to get down to something reasonably straightforward, but you have to get all the way through the words to get there. So all of these words are there to say that each and every loss really means each and every loss, or all of these things, but arising out of one event. So we're looking for an event as our aggregating unit. The question here was all about Dick Outhwaite's so-called blind spot. So he wrote 32 policies without having a sufficiently strong understanding of the risks that asbestosis, the risks that they pose to the business that he'd written. So he was negligent in doing that. But the question was, if he'd written 32 policies, was his so-called blind spot to this particular issue just one event, or was each scratch an event? And the Court of Appeal held that it was each scratch. So you have 32 events right there. And what Lord Justice Evans said was, the three requirements of a relevant event are that there's a common factor that can properly be described as an event, which satisfies the test of causation and which was not too remote for the purposes of the clause. So We've got particular time, particular place, particular way, what Lord Mustill said. We've got the unities test, and now we've also got something else that we need to bear in mind here, which is these three requirements. A common factor which can be described as an event is got to satisfy the test of causation, and it's not too remote for the purposes of the clause. So those two final things there, they are somewhat new in our analysis. So let's look at that in a bit more detail. And for that, we need to skip forward quite a few years to various eateries and alliances in the Court of Appeal. Some of you may have been following or even involved in. So this is a COVID case. The policy aggregated per single occurrence. And the court here confirmed that Lord Justice Evans was on the right lines back in Caudle and Sharp. So those are the three things that he said were required. The court confirmed that remoteness is really an aspect of causation. It's quite hard to distinguish the two. What is too remote? Well, they handed a whole load of work back to the coverage lawyers in the market by saying it just depends on the true construction of the policy language and the causal link required. So if you really want to know the answer, or at least an answer, then you might need to go for a coverage advice. But importantly, what they said was that unless the language in the policy makes it really pretty clear, we're not talking here about proximate cause. So you might have come across causation in other contexts, and you might have heard the expression proximate cause, which is a test which has got a lot of other legal baggage to it. It's a reasonably stringent test. And that is not what this is. It's a looser test. So the test of causation that needs to be satisfied in order to get over Evans' second hurdle, and probably his third hurdle as well, is somewhat looser. So there's quite a lot to go at here. I've pulled it together for you in this little cheat sheet. So the things to take away for event and occurrence are they usually mean the same thing. And Mustill said it's something happening at a particular time, in a particular place, in a particular way, and that's still good law. The unities test, time, location, and then cause, question mark, motive, intent is a useful guide, but it is just a guide. And we need to look for an event or occurrence which satisfies the causal requirements within the wording, whatever those may be, and is not too remote, which is really a subset of the cause point. So we could be looking at a range of things. We could be looking at an individual loss, like a collapsed wall, like a hurricane, an act of fraud or theft. Under the wording, we might be looking at a series of losses which are related. That would be sort of wide end of the spectrum. Seizing an airport for a war risk cover, an outbreak of COVID-19 in a particular location, and we could be looking at a decision. Those are all possible events, but it's going to come down to the facts, and it's going to come down to the words in the policy. So another sliding scale for you, and again, this is not like hard law by any means, and is all subject to context and every caveat that I can offer you. But again, on the wording side, people quite often say, well, Andrew, you know, what's wide and what's narrow? Well, I would say probably that is a reasonable guide. So on the narrow end, solely and directly caused by is probably one of the narrow ones that you would see. Caused by, arising from, resulting from, those are all pretty similar. And we've actually got some judicial comment on that in the FCA and Arch test case, where they said that the nuances of difference between those probably rarely result in anything significant by way of distinction. Arising out of, attributable to, relating to, following, those are all sort of getting wider. And then the widest one, or the wide one that you see most frequently, is probably in connection with. Various eateries had sort of covering the waterfront in a way, with arising from, attributable to, or in connection with, again, language you quite often see. But even with that, don't forget, you still need your causal link. Still need your causal link there. So those are not the only connecting words or causation words you'll ever see, but hopefully that gives you a bit of a steer for whether you are looking for something narrow, solely and directly caused by, or something a bit wider in connection with. Okay, so moving on to cause or source. I love a visual pun. My mother was not a very good cook, and that's one of hers. Horrible, horrible sauce. One of her horrible sauces, actually. She had a few. Don't let me get distracted. So we are looking at cause or source. So you see this more frequently in third party. Event occurrence is more often in first party, but it's by no means a sort of bright line between those two. So in Spire Healthcare and RSA, we mentioned it earlier, this was all about Mr. Patterson. Mr. Patterson was a surgeon who did bad things. And the clause in the policy issued by the artist formerly known as RSA is now intact. Said the total amount that we're going to pay arising out of all claims during any period of insurance consequent on or attributable to one source or original cause will be X. And Mr. Patterson did two classes of bad thing. The first thing he did was a series of negligent operations where he performed mastectomies, but he left some breast behind. So he wasn't very good when he was doing these operations, but he also performed a group of unnecessary operations. So those were the two classes of bad thing that he did. And the question was, were they consequent on or attributable to one source or original cause? Because there was quite a few of them. So the unifying factors across these two groups, if we analyze it, were the surgeon. He was dishonest. He had a practice of operating on patients without their informed consent, and he had disregard for his patients' welfare. I told you he was a bad guy. So those things we can use to, as a sort of facts, if you like, to apply the wording. Now, the Court of Appeal did not agree with the first instance decision. They thought that all of these claims were from the same source or original cause, because what Lord Justice Andrews said was, we're not talking about proximate cause. We are talking about a considerably looser causal connection. So it doesn't have to be the sole cause of the insured's liability. I am actually in the middle of a hailstorm. I don't know if that's interfering with the feed. Hopefully you can still hear me. So it doesn't have to be the sole cause. It doesn't have to be the proximate cause. It just has to be a cause. It's all the one bad guy. So Spire could only claim one limit of indemnity. Now, one thing you might be thinking as you're tracking all of this through is you sort of get a gut feel, and then you wonder whether the application of the facts to the detailed words then follows. And that's a fair question. I think sometimes when you're looking at these things, a gut feel that you have at the beginning can be something to bear in mind as you then go through the process of trying to work out what the facts really are, and then to put them through the gates that are set up by the policy. Don't ignore your gut, although it might not give you the right answer every time. So let's move on to per claim. No visual puns here, but a bugbear of mine, if you'll just indulge me for one moment, we need to establish at the outset what sort of claim we're talking about. So for first party business, which is where we insure against the risk of our own loss, so property, construction, that sort of thing. Here you've got the insurer and the insured, and the insured makes a claim on their policy against the insurer. So we call that a claim. But if we're doing third-party business, writing third-party business, where effectively we're insuring somebody against being sued, you've got the insurer and the insured, but you also are going to have a third-party claimant who claims against the insured. And a little confusingly, we call that a claim as well. And in your wordings, hopefully, there will be some way to distinguish between those two things. So maybe you define one claim and leave the other claim undefined. Well, there are other ways of doing it. But if we're going to aggregate per claim, we need to know which one of these we're talking about. So that's just a bit of a wordings tip for you to try to distinguish between those two things. But anyway, moving off that hobby horse of mine, let's look at AIG and Woodman, which, although 2017, is still very much a touchstone in this area. So this is a solicitor's case. 214 investors made a claim against solicitors because of two investment projects in Turkey and Morocco, respectively. And guess what? They didn't make any money. Their investments went south and they made claims. And the policy that was going to respond was under the solicitor's minimum terms, which has got quite wide aggregating language, which you can see on the screen. And you see this in other lines of PI business as well, actually. So it goes all the way through to E, similar acts or omissions in a series of related matters or transactions. They all get treated as one claim. So 2 projects, 1 firm, 214 investments. How many limits can you claim? The Supreme Court looked closely at the word related. See it there? Related. They said it needs the exercise of judgment based on the facts, which is a theme that hopefully I've been developing for you over the course of this talk. They said, on these facts, the 2 sets of claims are strikingly similar, but they're not a series of related claims. The connection in that case was too weak, and that was a decision that was made really based on the facts. So very similar, but not enough to aggregate them. So that meant the insurers were on the hook for more. We can see how this has played out in other factual sort of fact patterns. If we look at Axis and Discovery Land, Court of Appeal case, again, a solicitor's case. So we've got one solicitor misappropriating 2 payments into their client account. It's on the same transaction. The first payment was 14 odd million into the client account in April 2018. And then later, different date, at completion, the solicitor asked for another 9.3 million, which was paid in, but not actually by the same entity as paid the 14 million. It was an associated company. And we've got a limit of indemnity, as is often the case on solicitors PI, 3 million per claim. So how many claims do we have? It's the same language in the minimum terms. Confirming AIG and Woodman, related means a real or substantial connection, and we just assess it on the facts. And in that case, the Court of Appeal had said, we've got 2 separate frauds here. They can't be aggregated. So you get 2 lots of 3 million. Still not enough. But there you had 2. And then finally, this is an accountant's case, more recent, Ahmed and White. So White and Co are accountants. They have a related entity, MKP, and the allegations against them was that they gave negligent investment advice to a whole load of investors, and they had £2 million limit any one claim. And the aggregation provisions then said, well, but related claims are going to be treated as one claim, and that means claims alleging arising out of, based on, or attributable to the same fact, alleged facts or circumstances, same wrongful act, continuous, repeated, or related wrongful act. And again, the court was looking closely at the word related, and it said, yeah, actually, you can aggregate these because they're all based on how you read Section 165 of the Income Tax Act 2007, which looks quite different to the 2 previous cases, doesn't it? But again, if you're going to say that the courts can look at the facts and make an evaluation, well, not all facts are always going to produce a consistent, sort of steer for us for the future. And there are, of course, lots of things to distinguish the facts between all of these cases. Anyway, so moving on to our next our next way to aggregate. We're most of the way through these now. You'll be relieved to hear. Per premises. So, of course, this was a big one for the COVID claims. And here we have the Corbett and King case. So, in this case, we had an insured clause, or a clause listing the insured, that didn't just refer to Corbett and King Limited. It was Corbett and King Limited and the subsidiaries, and they were all listed out in the schedule. And it was a denial of access claim. And it said our liability, the insurer's liability for any one claim, won't exceed 250K. Or 100% of the sum insured, whichever is less. So Mrs. Justice Cockerill looked at this and she said, we need to look at aggregation a little bit differently here, because what we have in this case is a composite policy. So in effect, the insurers have provided separate cover to Corbett and King Limited and then to each of their subsidiaries. So composite cover means that effectively we need to read this as a series of separate contracts. And if you're going to do that, well, then each insured makes its own claim and you get 250K each. So we're quite used to seeing composite policies, for example, in D&O, where all of the insured persons are deemed to have their own cover. It's less common in property. But of course, the lesson from this is make sure that you know whether or not you're offering composite insurance. And if you are, then how's your limits going to work? You need to be super clear about that. And a similar approach in the Court of Appeal in Liberty and Bath Racecourse. Another case, another COVID case per premises. The policyholder here was IEH and its group companies. The aggregation language here is an object lesson in how not to do it. So the liability of the insurer for any one claim in the ag during any one period of insurance won't be more than £500,000. Did anyone spot the problem there? There is a problem. So the court held it's £500,000 per premises, but the court also held something's gone wrong here. The phrase during any one period of insurance doesn't make sense if you've only got one period of insurance, and a limit can't sensibly apply to any one claim, and also in the ag. Okay, so if anyone's thinking of putting into their policy any one claim in the aggregate, you are baking in a nice little coverage dispute for the likes of me and my colleagues in the future. So that's not correct, not recommended. The court actually said the solution isn't clear. There's two alternatives. It's not obvious which was intended. What are we going to do? It's pretty tricky, is what they said. And I have some sympathy with them because indeed it was quite tricky. So they found that the way that should work is £500,000 limit per premises. But this is a long, words on the screen are a long complaint from a judge about the case they've been presented with. And then here, this is a recent one, again, Bath Racecourse and Liberty Mutual, which have been bouncing around the courts for some time. And the thing here is that the claimants, there are a few of them, operated various facilities around the country. So racecourses, greyhound tracks, golf clubs, hotels, and a pub. Sometimes all, there'd be a group of them, a cluster of them all together, sometimes in different locations. So this is a first instance hearing on preliminary issues. And the judge said, okay, well, the trigger is when damage occurs at the premises. Super unhelpful for these non-damage BI claims. But anyway, what we're looking for is a trigger occurring at the premises used by the insured for the purpose of the business. And very importantly, he said, when I look at the policy in detail, I see that there are different maximum indemnity periods for these different facilities. So how am I going to work my aggregation? We've got a sum insured any one loss, but what does that mean? He said, I really don't know. But by virtue of the fact that the policy is applying different maximum indemnity periods for different facilities, that suggests that you should be able to claim per facility. So that's the way I'm going to read any one loss. I'm going to actually read it as any one facility, not even premises, but facility. So even if you had a race course and a golf club and a hotel all on the same site, those are three different facilities. So they each get 2.5 million. Let's see whether that gets appealed. Another complaint, though, from Sean O'Sullivan KC, who was the deputy judge who gave the judgment, which is worth sharing with you because it illustrates some of the frustrations that decision makers feel when they're trying to work out how aggregation should work. He said, a loss or a loss calculation isn't really the same as a trigger event or a claim, although there's quite a lot of overlap between them. You could have a trigger event, but then there's no loss. You could have a loss, but then the insured never makes a claim. But normally, those things are all quite close. So they're all like three dominoes in a line, falling one after the other. And it might be hard to identify much of a gap between them. And that sort of illustrates why this is a tricky area, because the particular word that you use could have a significant impact. And working out how to construe these clauses on the basis of the facts is something which has given judges and arbitrators a headache for my entire career. You might say long may it last, but hopefully you can see here there are some things to avoid. Now, coming towards the end, per catastrophe, one of my favorites. It's a reinsurance case, this one, Unipulsine Covéa, and it's actually an appeal of a tribunal's aggregation decision and another COVID-19 case. Originally, there were two, actually. It was Markel and Covéa. Each had aggregation decisions, which were heard together. But anyway, so the reinsurance deductible looks like this. So it's 10 million quid, ultimate net loss, each and every loss occurrence being capitalized, so it's defined. All individual losses arising out of and directly occasioned by one catastrophe. The catastrophe, as is often the case, normally the case, not defined. So what is a catastrophe? And we also have these words: no individual loss from any insured period occurring outside a 168-hour period shall be included in a loss occurrence. So you had to group your losses into a 168-hour period. We'll look at hours clauses in a second. So at first instance, Mr. Justice Foxton went into a lot of detail about how you should read catastrophe. He said it doesn't have to cause physical damage, need not be sudden or violent. It doesn't need to satisfy the unities test. It's wider than that. It should be capable of directly causing covered loss, individual losses. It should be something which can fairly be regarded as coherent, particular, and readily identifiable, happening with an existence, identity, and catastrophic character that arises from more than the mere fact that it causes loss. It should allow you to work out when it starts and when it ends, and it should involve an adverse change on a significant scale. And by the time you got to the end of that, you might be thinking, oh, God, that is quite the test, Mr. Justice Foxton. Is it going to be readily applicable in every scenario? Not sure. Anyway, the Court of Appeal didn't overturn his decision, but it also didn't repeat this long laundry list of things. What the Court of Appeal said was, COVID-19 outbreak, that wasn't exactly a state of affairs. The judge was on the money when he said it didn't need to be sudden. It didn't need to cause physical damage, because this isn't physical damage cover. And they upheld the ultimate decision, which is we are looking at one catastrophe. COVID was one catastrophe for this purpose. There was an hours clause wording that we quoted a couple of slides ago, but that doesn't make a difference. It was enough that the interruption began during the hours period. So you want to know what a catastrophe is? Are we any the wiser? Well, we've got some guidance now from the courts, but typically catastrophe is intended to be very wide, and so traditionally has not been defined in reinsurance policies and some first-party policies as well. So I threatened to talk about hours clauses. I'll just show you one here so that you can see the way that they work. And what they really do is to give us a bit more flesh on the bone about how we are going to apply our aggregating factor. So normally you'd have a limits clause that says 10 million, any loss occurrence. And then when we're trying to work out what loss occurrence is, we have to go to any hours clause there might be and then apply it. So here, how we're going to slice and dice the underlying facts and the underlying losses is going to depend on the peril. So if there was a hurricane, then we can have 72 consecutive hours worth of loss, and that will be one loss occurrence. And anything after that 72-hour period, well, that will be another loss occurrence, and you may or may not have cover for that second occurrence. It depends what the words say. But then if you were looking at something that's not A, B, or C, that's a peril that's not dealt with above, like I don't know, but not riots, not earthquakes, seaquakes, not hurricanes and weather, then it's 168 hours that you'd be using. And what should you be watching out for when you're reading the hours clause? Well, obviously the number of hours, but often they deal with who gets to decide when the hours period begins. Frequently, it's the cedant or the insured. Does it deal with what happens if it runs past policy expiry? That sometimes comes up for debate. And a problem that I've seen very many times is a mismatch of hour clauses, either up the tower of cover or going out this way between different parts of the reinsurance protections. And that can be a real headache if people are grouping underlying losses in different ways. There's also a thing called a sole judge clause, which is highly relevant to this area. So you might have a limit deductible, which talks about per loss or per event, but then you might have something like this. So the insured or the reassured or the reinsured or the cedant shall be the sole judge about what constitutes each and every loss and or event. So at that point, you have got to ask yourself, right, they're doing the judging. What does that really mean? And we know what it means from Brown and GIO. Appreciate I've got 1 minute left. Mr. Brown said that an individual underwriter's negligent underwriting, more negligent underwriting over time is all one event. The Court of Appeal said, well, you are the sole judge, so what you say goes, provided that you do it reasonably and in good faith. So if you've got a sole judge clause and it gets applied unreasonably or in bad faith, then you may be able to challenge the aggregation decision. But if not, then not. And then other rinky-dinks, if you have, for example, renewable energy, you can have some interesting aggregation provisions. And you can see this in other lines of business as well. There's all sorts of interesting ways in which people can aggregate. Here, I'm just sharing this with you because you can see it's on a sliding scale depending on the number of claims. So it changes over time. And these sorts of things where you can change the value of the limit or the value of the deductible can be particularly fiddly. So the first two there, aggregate extension, aggregate deductible, this is when we're looking at trying to limit the amount that the insured is retaining, drop-down clauses, certain number of losses, and then the whole tower moves. All of these moving parts require particular care. So on 11 o'clock, some conclusions. I think you got the idea. There's loads of case law, but it's all about the contract and the underlying facts. Remember my sliding scales, but don't quote them against me in court because they're not intended to be binding. Limits and deductibles are offered in compressed language, which is one of the key reasons why you see so much litigation here. Be careful about whether you are trying to game this, because my advantage today could be your advantage tomorrow. And the final thought I want to leave you with is, if it's a large risk or one that's important to you, could you consider knocking out a few aggregation scenarios before the risk is placed? Often those sorts of things will flush out any problems that you may have, and they could be super helpful. And I'll leave you with the selfie that I get most often on my phone. the Firebeard. You can tell she's the daughter of a litigator. Look at that. Okay, 1 minute over. Sorry about that, but any Q&A if we've got time, Tom? I don't know if we do.
Yeah, not to worry, Andrew. There was plenty to get through, and I was furiously taking notes for things that would inform our own drafting. So some really helpful tips and tricks in there. So thanks for sharing your wisdom and lots of amusing selfies as always. We did have one question, so perhaps we'll deal with that and then we'll log off. And it is an interesting one. If you replaced Mr. Uthwaite's actions with AI, would the outcome likely be the same? So it's a very good question.
It is a very good question. So if AI was overlooking asbestos and doing the underwriting, does that change things? Well, I mean, I suppose to go back to the core caveats, like it depends on the wording. Um, and there is a sense here that people do slightly shape the outcomes of these decisions according to their gut feel. So there is a sort of gut feel aspect to it. Um, I think that probably the outcome ought to be the same because whenever we're looking at AI perils in this market right now, what we're trying to do is to strip out the technology and then work out whether our insuring clauses get triggered, and then we look at aggregation in the same way. But I can also see that again, sort of on gut feel, if it's an AI agent, underwriting agent, some sort of algorithm that's making the decisions, it does feel more like one thing. It does feel more like one thing. The blind spot is one of those things within artificial intelligence that we're all looking at as being a potential cause of loss. It feels more like a sort of product liability type scenario. So it's a very good question. If you have that scenario ever come up and it litigates, then I'm your man.
It may well do, and we could probably have an hour and just try and answer that question. Um, Now there is just one final question to deal with. Is it the case that the outcome of these the particular cases you talked about during the session depend on who is the decision maker? So maybe just a brief comment on that one before we close.
Well, judges are human beings, arbitrators are human beings. So, an exercise that I often do when I'm teaching is I make you be the judge or the arbitrator, and you'll see how difficult it is. But in order to help the decision maker, we do have all of this precedent and case law to try to bring certainty. So the answer is that inevitably there is a human element, and you can't discount that. But if you have some facts that fall four square within an existing precedent, then certainly in this jurisdiction, you ought to get the same outcome if you go before a judge or an arbitrator. It doesn't always work that way, but you then have the opportunity to appeal on a point of law, unless you're arbitrating in the LCIA, and so you should get the same outcome. There is a sort of uniformity that the law should give you, but I can't promise that it will be exactly the same every time.
Yeah, it's the I suppose the benefit and the challenge of case law, isn't it? We have this layering over time, but of course sometimes we're taking slightly different directions by new decisions, and we try to have a catch-all session on an annual basis to pick up the important cases of the last year. But actually, a good few of those appeared in this session, which is brilliant. So Andrew, I think that deals with all of the questions that came through. Lots of positive comments coming through from people to thank you for the work that's gone in. So I can only reiterate the thanks from everyone. And then of course, just to pass on some thanks to everyone for dialing in and for bearing with us. I know we're a couple of minutes over time, but we hope you enjoyed the session and we will share the slides and the recording in due course. So thank you all very much, and I hope you enjoy the rest of the day.